This was a scam designed to make money appear in your bank account as real before taking it all back without warning. It was known as an overpayment check scam, targeting online sellers, freelancers, and small businesses involved in genuine transactions. The process looked legitimate. A buyer sent a check for more than the agreed amount, explaining it as a mistake, shipping cost, or third-party payment. The bank reflected the funds in the account balance, often within days, creating the illusion that the money had cleared and was available. Nothing in that moment suggested risk. The transaction followed what appeared to be normal banking behavior. The buyer then requested the excess amount to be refunded or asked for the goods to be released immediately based on the visible balance. That was the irreversible step, where the seller acted on money that had not actually settled within the banking system. The refund was sent, or the goods were shipped, completing the victim's side of the transaction. Days later, the bank reversed the deposit after identifying the check as fraudulent or unsupported, and the balance that once showed available funds disappeared, leaving the victim with both financial loss and no recovery path.
By the early 2000s, as online marketplaces like eBay and Craigslist expanded across the United States and Canada, high-value peer-to-peer transactions became common without physical interaction. Sellers began listing cars, electronics, and later freelance services, often dealing with buyers they had never met, and verifying trust only through digital communication. The primary targets were individuals and small businesses, people shipping goods or delivering services without institutional protection or escrow safeguards. Payments by check were still widely accepted, especially for large amounts, because they were seen as formal, documented, and bank-backed. That assumption created a critical weakness in the system. Banks often made funds appear available within a short window, even though full verification of the check could take several days or longer. To the seller, the balance looked real, accessible, and confirmed within their account. Nothing in that moment indicated that the transaction was incomplete or at risk of reversal. That visibility created a false sense of security that influenced immediate decisions. And once sellers trusted the displayed balance, the conditions for the scam were already in place.
The contact usually began with what looked like a normal buyer inquiry, responding to a listing with clear intent to purchase without unnecessary negotiation. The buyer often appeared decisive, sometimes offering to pay quickly or even slightly above the asking price to secure the deal. Communication moved smoothly through email or messaging, with no obvious signs of manipulation or pressure at this stage. The explanation for overpayment was introduced casually, often framed as a mistake, a combined payment for multiple items, or inclusion of shipping handled by a third party. The buyer would insist on sending a single check covering the full amount, including the excess that needed to be returned. This created a structured but subtle setup where the seller accepted the logic without questioning the payment flow. The check itself looked legitimate, sometimes issued under a business name or designed to resemble official banking documents. At this point, nothing felt like a scam. The transaction appeared organized and aligned with real-world payment behavior. The seller deposited the check, expecting a standard clearing process before completing the deal. And once the deposit was made, the scam had successfully entered the transaction without resistance. Once the check was deposited, the bank system began processing it in stages that were not visible to the seller. Within a short time, part or all of the amount appeared in the account balance as available funds, creating the impression that the check had cleared. In reality, the bank had only provided provisional credit while the actual verification process was still ongoing behind the scenes. That distinction was not obvious because the account interface showed no warning that the funds were still at risk of reversal. The buyer then re-entered the conversation, referring to the visible balance as confirmation that the payment had been successfully completed. Instructions followed immediately, requesting the excess amount to be refunded via wire transfer, gift cards, or alternative payment channels. These methods were chosen deliberately because they were fast, irreversible, and outside the traditional banking recovery system. At that moment, the seller relied on what the bank displayed, not on the underlying settlement process that was still incomplete. The money being refunded was not actually secured. It was being sent out against a deposit that had not yet been validated. And once that transfer was executed, control over the transaction was lost, even though the bank had not yet finished verifying the check. Once the refund or shipment was completed, the buyer maintained communication to reinforce that everything was progressing normally. Messages became more structured, referencing delivery timelines, third-party pickup arrangements, or confirmation of funds movement. In some cases, additional requests were introduced, such as minor fees or adjustments, keeping the transaction active and preventing suspicion. The seller, already committed, continued engaging because the visible balance still supported the belief that the deal was legitimate. This created a controlled delay, allowing time for the banking system to continue processing the original check in the background. At this stage, nothing appeared broken, the account still showed funds, and the transaction seemed aligned with expected timelines. That delay was critical because it extended the window before the underlying fraud was detected. The seller had already completed their side, either by sending money or releasing goods based on the displayed balance. That was the irreversible point, where reversing the transaction was no longer possible from the seller's side. And the longer the communication continued, the less likely the seller was to question the legitimacy before the check verification failed. The first sign of failure appeared without warning, when the bank notified the seller that the deposited check could not be verified and had been returned. The balance that previously showed available funds was suddenly adjusted, removing the full amount that had been credited during provisional clearing. At that moment, the seller realized the money they had relied on had never actually settled within the banking system. The refund that had already been sent, or the goods that had already been shipped, could not be reversed through normal channels. The buyer stopped responding or disappeared entirely from all communication platforms used during the transaction. Attempts to trace the payment led to dead ends, as funds sent through wire transfers or alternative methods had already moved beyond recovery. In many cases, the financial loss extended beyond the original deal value, including additional fees or multiple payments made during the process. The impact was not limited to money. It affected business operations, personal finances, and in some cases created ongoing debt obligations. There was no immediate resolution because the transaction had been completed under a false assumption of secured funds, and what appeared to be a legitimate payment process ended as a complete financial loss with no direct path to recovery. What initially appeared as isolated incidents began to surface across multiple online marketplaces, freelance platforms, and classified listings during the mid-2000s and into the 2010s. Victims who had never interacted with each other described nearly identical transaction patterns involving overpayment checks and refund requests. The structure repeated with consistency: different buyers, different items, but the same sequence of payment, visible balance, refund, and reversal. That repetition indicated coordination rather than coincidence, suggesting organized scam groups operating at scale. In some cases, identical check formats and communication templates were identified across different regions,
linking multiple incidents to shared sources. Online forums and consumer protection platforms began documenting these cases, creating early awareness among sellers and small businesses. Financial institutions also started flagging unusual deposit and withdrawal patterns tied to newly opened accounts and rapid fund movement. These signals formed the first layer of partial exposure, where patterns became visible, but the full network remained unclear. Authorities began receiving reports supported by transaction records, email trails, and bank documentation from affected individuals. But by the time these patterns were recognized, the scam had already expanded across borders and adapted its methods to avoid immediate detection.
As reports accumulated across the United States, Canada, the United Kingdom, and parts of Europe, investigations began linking overpayment check scams to organized fraud networks operating across multiple jurisdictions. Analysis of the checks revealed patterns in printing methods, routing details, and account structures, often tied to compromised or fabricated financial identities. The funds received from victims were typically moved through mule accounts, quickly transferred across banks, and withdrawn or converted before detection systems could respond. In several cases, local participants involved in receiving and moving funds were identified and arrested, particularly those managing bank accounts or handling withdrawals. However, the central organizers often remained outside direct reach, operating through layered communication channels and cross-border coordination. Law enforcement agencies, including cybercrime and financial fraud units, confirmed that the scam relied on exploiting banking system delays rather than breaching security systems. Public warnings were issued, emphasizing that visible balances did not guarantee cleared funds and that checks could still be reversed days after deposit. Despite increased awareness, recovery rates remained low, as funds were typically moved within hours of being refunded by victims. The investigation established that the scam's effectiveness came from combining legitimate banking processes with controlled manipulation of trust. What began as individual transaction failures was ultimately identified as a widespread financial scam targeting the delay between check visibility and actual settlement.